This is an Uncovered Japan company research report on Shift Inc., ticker 3697. Shift is Japan's largest independent software quality assurance specialist. It helps customers plan, execute, and manage software testing, then adds adjacent development work. The investment question is whether its scale and training model can keep converting Japan's digital transformation spending into profitable growth as artificial intelligence changes both the opportunity and the pricing risk. At the report date, Shift traded around 18 times fiscal 2026 estimated earnings, with a 4.1 times price-to-book ratio and no dividend. Those multiples are much lower than the company's own historical valuation, but they sit around the IT services sector average. What supports the premium book value is a 24.1% return on equity and nearly 30% 5-year revenue growth. The counterweight is that investors need evidence that the next growth phase can preserve margins. Shift's service is best understood as an operating workflow. A customer brings a digital product and its requirements. Shift helps turn those into test plans and manage test cases, then combines automation with trained people testing desktop and mobile software. Defects are documented and returned to the product team, allowing the next release to improve. This visual is an explanatory diagram rather than a depiction of a proprietary product. The economic value comes from scaling disciplined quality assurance in a Japanese market where experienced digital talent remains scarce. Shift has built from testing into a broader portfolio, but software test-related work remains central. In the report's segment view, testing generated 20.6 billion yen of operating profit. Development-related activity generated 5.6 billion, and adjacent businesses contributed 8.6 billion. The strategic attraction is cross-selling. Testing relationships can open development, security, consulting, and other work. The risk is that lower margin activities and acquisitions can dilute the clean economics of the core testing franchise. The historical growth record is unusually strong. Revenue expanded from 46.0 billion yen in fiscal 2021 to 129.8 billion yen in fiscal 2025, a compound annual rate of 29.6%. Operating profit also rose from 4.0 to 15.6 billion yen across the period. Although the path was not straight, profit slipped in fiscal 2024 as hiring and investment increased. The key message is that Shift has demonstrated demand and execution at scale. The current debate is about the cost and quality of the next increment of growth. Operating profit roughly quadrupled over 5 years, while net income was more uneven. Fiscal 2024 net income fell as impairments made the accounting result look weaker than the underlying operating trend. Fiscal 2025 net income recovered to 8.9 billion yen. For investors, that distinction matters. Growth through hiring and acquisitions can create both profit volatility and goodwill risk. The report therefore focuses on operating margins, cash conversion, and whether management can avoid turning expansion into recurring impairment charges. The report's model has free cash flow dipping to 8.5 billion yen in fiscal 2026, before rebuilding to 15.6 billion in fiscal 2027 and 18.3 billion in fiscal 2028. This is an author model, not company guidance. It captures the central operating tension. Shift is spending on talent and artificial intelligence capability now, while investors want proof that those investments lead to a stronger revenue and margin profile later. Cash conversion is therefore one of the cleanest checks on the growth narrative. Shift's moat is not simply its brand. Japan's software quality assurance market is large, while the company remains relatively underpenetrated. Its advantage is the ability to recruit, train, standardize, and deploy people at scale. Then, use established customer relationships to add work. That can be a powerful operational flywheel in a talent-constrained market. But it is labor-intensive and founder-led, so the moat must be continually renewed through hiring quality, retention, and successful adaptation to AI-enabled testing. Management's longer-term Shift 3000 ambition is 300 billion yen of revenue, up from roughly 130 billion yen in fiscal 2025. The report's nearer-term model reaches around 190 billion yen by fiscal 2028. The arithmetic requires continued penetration of testing, higher value work around development in AI, and disciplined expansion. Ambitions alone do not support evaluation. The practical test is whether hiring, project mix, and margins show that growth is becoming more valuable rather than merely larger. The valuation reset is dramatic. Shift's trailing price-to-earnings ratio was about 155 times in fiscal 2021, fell to 45 times by fiscal 2025, and was roughly 20.5 times at the report date. That makes the shares far cheaper versus their own history, but not automatically cheap versus the IT services sector. The market appears to be asking for a more balanced proof set: durable growth, a recovery in margins, and evidence that AI is an opportunity rather than a source of price pressure. The report's scenario analysis spans a wide range to fiscal 2028. The bear case is 505 yen, or 18% below the report date price. The base case is 1,259 yen, or 104% above it, while the bull case is 2,134 yen. These are analytical scenarios, not price targets or recommendations. The range tells us what matters: second half profit recovery, the economics of AI-related services, continued hiring effectiveness, and whether the market rewards growth with a higher or lower earnings multiple. Shift combines a distinctive quality assurance niche, a proven scale and training model, and historically strong returns on equity. The stock is cheaper than it was, but the report sees it as roughly sector average rather than obviously distressed. The next evidence points are concrete. Can profits recover as investment normalizes? And can generative AI create higher value services instead of price deflation? Those answers, along with cash conversion and acquisition discipline, will determine whether this is a renewed compounder or a growth story that needs more proof. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.